told you that a single rate cut could change your mortgage payment by over $400 a month. That's not a headline. That's real math. If you're thinking about buying a home, refinancing, or wondering why housing still feels impossible even when rates fall, this video is for you. Today, I'm breaking down what a $600,000 mortgage actually costs right now, after the Fed's latest move, and why most people completely misunderstand what this means. Stay with me because the numbers tell a very different story than the headlines. Here's what just happened. The Federal Reserve cut interest rates again. This move came as inflation cooled and economic growth slowed, and immediately people started asking the same question. Does this finally make housing affordable again? But here's the part most people get wrong. The Fed does not set mortgage rates. Mortgage rates are driven by long-term bonds, investor expectations, and market confidence. When the Fed cuts rates, markets expect borrowing to get cheaper, and mortgage rates often fall as a result. That's what we're seeing now. And the impact is bigger than it looks. Just a few months ago, mortgage rates were sitting above 7%. At that level, buyers weren't just uncomfortable, many were completely priced out. At 7%, a $600,000 mortgage came with a monthly payment of around $4,000. That's before property taxes, before insurance, before repairs. Now fast forward to today. After recent rate cuts, average mortgage rates are closer to 6%. That 1% drop doesn't sound dramatic, but financially, it's massive. Let's look at the actual numbers. Here's the scenario. $600,000. 30-year fixed mortgage. Around 6% interest. That puts your monthly payment at roughly $3,590. Now compare that to 7%. At 7%, the payment jumps to just over $4,000. That's about $415 more every month. Over a year, that's nearly $5,000 saved. Same house, same loan, different rate. That's not hype. That's math. Now here's where buyers actually get options. You could choose a 30-year mortgage and keep your monthly payment lower. Or you could go with a 15-year mortgage. The rate is lower, around 5.3%, but the payment jumps to roughly $4,850 a month. Yes, it's higher, but over time you save hundreds of thousands in interest. Lower rates don't just make homes cheaper. They give you choices, and choices are power. Here's why timing matters. When rates fall, buyers come back. When buyers come back, competition increases. And when competition increases, prices usually rise again. So while lower rates help affordability, waiting too long can erase the benefit. This is why moments like this don't last forever. The window opens and then it quietly closes. Here's how informed buyers and homeowners approach this. If you're buying, don't try to time the perfect bottom. Lock a rate when the payment fits your budget. If you already own a home and your rate is above 7%, refinancing might make sense, but only after running the numbers. And if you're waiting, watch rates calmly and consistently. The most expensive mistakes usually come from panic or doing nothing without a plan. This rate cut didn't magically fix housing, but it did reopen a door that was closed for a lot of people. A $600,000 mortgage today is meaningfully cheaper than it was just months ago. And for many families, that difference determines whether buying a home is realistic or not. If this helped you understand Fed's rate cut, and if you want more of a clear, simple breakdowns of money, housing, and real-world finance, subscribe to the channel. As always, thank you for watching, and I'll see you in the next video.